Maverick. Noun, unusual person. A visionary, leader, go-getter, an independent thinker. They see the vision for their life and pull that future towards them with an unyielding belief that things can and must be better. They achieve what most won't. Innovative, influential, daring, and direct, with a remarkably high tolerance for taking calculated risk. A foe to the status quo. This is Passive Real Estate Investing with Mavericks. Your host, Neil Timmins, has been involved with over $300 million in real estate transactions. He's a published author, commercial property investor, and real estate syndicator. This show is for those who want to learn how to earn passive income through real estate investing. Now, here's your host, Neil Timmins.
Welcome to Passive Real Estate Investing with Mavericks podcast, where we provide actionable steps to grow your passive income and become job optional. During this episode, you're going to discover why buying newer and bigger is better. For those of you who are new, welcome. I'm your host, Neil Timmins. I love passive income from real estate. Before I introduce you to today's Maverick, I want to make a request that at any point, if you like what you're hearing, give us a thumbs up or subscribe to the show to never miss a valuable episode. And if you love what you're hearing, well, give us a written review. And please be sure to look in the description of the show notes of today's episode, as we packed it with thousands of dollars in free resources. Well, today we've got the privilege to learn from a person who I would describe as extraordinarily passionate about real estate and is a fund operator in multifamily space out in California. Prior to his career in real estate, he was an active military, but that all changed when he picked up his very first book on real estate. And I would describe today's Maverick as somebody who's passionate about doing bigger deals and doing them in his own backyard. Today's Maverick, Victor Bell. I'm excited to have him here. Victor, how are you?
I'm doing great today. Thanks so much for having me on. I really appreciate it.
You bet. I appreciate you being here. Well, let's do this for the audience's sake. Who are you? Where are you from? What do you do?
Real estate. I've been doing real estate for 20 plus years. It's crazy to even say that. I'm actually here in San Diego County now in Oceanside. I just got here from Hawaii. I was in Hawaii for the last 17 years, right? Poor Victor. Yeah. Investing and doing stuff. We have a real estate fund. We're working and we're out looking at deals every day, like just probably like a lot of other real estate people out there, or, you know, it's something anybody interested in investing in real estate wants to know. Right.
Yeah.
That's a little about me.
Tell me about, before I jump too deep, I'm curious, what part of Hawaii were you in and what brought you back, you know, land stateside, if you will?
Right. So I was on Oahu there. So okay. I was younger, I was stationed there, went back to Texas, which is where I was originally from, and then got married. And then we went back because my wife was military, and we were stationed. She was stationed there and retired there, and we did a bunch of real estate deals there. So we were on Oahu, and once we sold our last couple of apartment buildings, I kind of had the big wake up call, like, "Oh wow, dude, you need to get back to work." And we looked around there and looked at what we wanted to do and what was the next frontier for us, and we decided to move to California. So in San Diego was as comparable as I could get to Hawaii. The beach, the palm trees, you know, the sun. So that's why we chose San Diego.
No, that's terrific. Well, thanks for your service.
Thank you. You know, I say that I went in when I was younger. It was a very different time. And I always kind of have a joke. If people saw me when I was in the military, no one would thank me at all. They're like, wow, dude, you partied a lot. But no, thank you. I appreciate that.
You bet. Well, tell me about the very first commercial property, multifamily property that you bought.
Okay. Yeah, sure. So, little backstop on getting into it. So I left home really young, 12 and a half, had my first kid when I was young, got kicked out of high school. And that's when I ended up joining the military later. And as I got out, dropped out of college, you know, had to get a job, started working. I got in trouble and I got a book from the store. That's the cliff notes of my life leading up to there. And that book was about, you know, buying real estate, you know, fast cash, blah, blah, blah. So I ended up calling out of the newspaper on a house that was for sale by owner at the time. And, later found a partner who they're still my partners today, in Bell Capital. And they were like, hey, call these people back and see if they have more real estate. And they did. They're like, yeah, man, we got 300 properties. So within the purchase of that house with my partners that I found, there was all the other multifamily that came in. So my first deal turned out to be a package deal that had duplexes, triplex in there, a 6-unit, 12 and 8, things like that. So that was kind of my segue into the multifamily investing, but really it was a real estate deal. So I got thrown to the wolves, at the same time as I went in with the sharks. So it was pretty fun.
Like 0 to 100 real fast in terms of speed, right?
Yeah, very fast. Like all of a sudden, all of the things that people are now naturally, it's a lot easier thanks to guys like yourself who have these shows and they're educating people. There wasn't that then. It was like Hastings bookstore.
Sure. Right.
And that was it.
Yeah.
So yeah, but it was a really good thing. I learned a lot. I did not know what I was doing. I did have some people who were helping me over time, things like that. But realistically, I cut my teeth on it. But that deal, that whole package was like 1.2 million. And back then that was a big deal for me because I had never done anything before. So the lessons were, similar, I guess, to anyone else when they first started, like understanding the leases, understanding management, understanding, you have properties, that money's not all coming to you. It has to pay bills. So, there's a lot of lessons in there too for that.
How did you end up funding that deal?
I cold called. Same way I cold called out of the phone book. Same way I cold called out of the newspaper. I cold called out of the phone book as well because the book was like, call lenders in the newspaper or not in the phone book. So I was in the yellow pages. I got from the A's to the S's before I got someone who would actually listen to me. And Bob and Jamie, they owned a mortgage company at the time. And Bob was like, you don't even know what you're doing, dude. How'd you get this number? I told him, and he was like, come into my office. Let me show you, because he was intrigued that I even got that far cold calling. Cause I think at the time they probably had people that were supposed to be doing that weren't.
Wow. Well, the A to S, clearly you were dialed in and didn't give up.
Yeah, I was afraid because I had already got a yes from the guy his name was Junior, from the guy in the for sale by owner piece of the newspaper.
For the property. Right.
Yeah. So, it was no contract, no nothing. It was just, yeah, sure. Come in tomorrow. And I was like, oh my God. Like, and then I'm thumbing through the book. Like there's no chapter on what to do next. But
so good, man.
Yeah. So that's how that worked out. And me and Bob did a lot of properties and stuff like that. Jamie actually is our investor relations manager in Bell Capital. Their company's closed since then. But it was a lot of lessons because I learned creative financing. I learned a lot about, debt and how to structure things. And, naturally I learned a lot about the real estate through experience because I kept doing deals.
Yep.
So it was a great journey, man. It was a blessing.
Speaking about doing deals, tell me about the most recent deal you did.
For the fund, naturally, we started a fund. So that's a deal per se, but that's not our deal. So one of the other deals we did 4 deals, actually. We picked up another couple of properties in Hawaii since we've been here. Yeah. That was a personal deal. It was just a single family house. But my multifamily deal, we sold off a small portfolio of properties that we had in Hawaii. We end up making 900 on one, 700 on the other, 400 on the other. So when we did those deals, but I was the guy who found the same strategy. I found the deal, found the investor, lined up all the debt, and then we oversaw the management, and then refinanced it in 3 years, and then paid off our investors. Yep. And then we stayed in that deal for another 8 years or so until 7 years, and then the debt. And then we sold that off and kind of doubled or tripled on a couple of them what we would have had in the deal, even though we had already recapitalized.
Sure. Your investors in that particular one, were they on the debt side or were they on the equity side?
Equity side.
Yep. Came in, participated, and took the ride with you.
Yeah, everyone made a lot of money on that deal. Like I said, there's always ups and downs because I try to explain to people in multifamily, it's not like a home because I buy houses and stuff too, right, on the side. But, multifamily, it's a long ride. It's an actual investment. It's good for passive investors who want to get involved in multifamily, who's like, look, I have a business or we have a retirement account or whatever, and we want to just invest passively into a deal that is making money with somebody who knows what they're doing to manage that. And we get those to returns and we just want to ride, right? That's a lot easier. And multifamily to me is designed for that. That's really what it's for.
Yeah. Tell me, between that first deal you did and the most recent deal, what were the biggest lessons you learned along the way?
Get a better quality of asset. Naturally, from the multifamily deals that we did in the beginning, there were older properties, Texas type stuff. All the other stuff was Hawaii, better locations. And be honest with you, my older stuff was a lot of creative financing because of the time than when I got started, right? Back in the 90s. But it is a lot easier to just raise the money, get regular, debt, bank financing for commercial loans, and manage a quality asset in a better location than it was to get creative financing and do a bunch of work and manage a bunch of tenants and stuff like that. Like it was a lot easier to do what I'm doing now because the level of quality is better and the locations are better. And naturally I know more, right?
Tell me the level of quality. What kind of classes are you buying then when you say, improve that quality?
B class properties right now, B properties, B areas, B plus areas. Even for the fund, we're looking for B plus, B to B plus or something that could be a B to take into a B plus. But the area is vital for us, especially that we're looking here in San Diego County. We're looking for location plays where we know that the location itself is going to give the rent pull over, 7 years, as opposed to just the asset, because the asset's the asset, right? We can paint it. We can do parking lots, palm trees, lighting. But in the end, if it's not a location where people want to, the rents are going to continue to rise because of job growth around that area, it won't do anything. So that's the quality of assets that we're going after. And naturally, if you have to put together the capital with your investors, and you got to do that anyways, it's just better to go after a nicer deal, right?
You can change everything except the location, right?
That is right. That's a harsh lesson.
Yeah, you're right about that. Tell me, in today's environment, how are you borrowing funds? What kind of structure, when you think about that, how long are you going out on those locks? What's that look like?
Are you talking about the actual debt side? Or are you talking about
the actual debt side? Yeah.
So all of our debt that we look at is anywhere from 5 years to 7 years on any of the debt. And, interest only if we can get it, because we're underwriting at putting down 40% and up to 45% down, especially in the markets that we're in. So it's just a clean deal because we're looking for a long-term thing. If we're going to refinance at any point, which is why we initially asked for 5 years and take a look at what our debt is going to look like then, because we're going to, we're like, hey, can we bump rents over this next 5 years, refinance, pay our investors back, pull that out, and then keep for our next whatever if we're going to reset that clock. But we just keep the debt very clean. And it's bigger debt because all the deals we're looking at now range from 30 million to about 50 million.
Typically debt you're borrowing from who? A life insurance company? A big national bank?
My guy over at Berkadia kind of sizes all our stuff, JLL, things like that, CBRE. So they're bigger players in the debt market.
Got it. When you're looking for this, what makes a property, an opportunity, a deal for you? What types of things are you looking for?
First, location, like I said before, right? The property needs to be in good condition. Typically, I'm here in California, so some places are going to be different. Some are older, some are newer, right? But 90s product somewhere in there, because I feel like that still has the right amenities. Other than that, back in the 70s, that older stuff where people had it's functionally weird, where you got to walk through a bedroom to get to a bathroom, stuff like that. Mm-hmm. So a little bit newer product for where we are, for the limited amount of product that can come on, that's a good deal for us. So 90s product, great location, near hospitals. I like hospitals. I like the vicinity of any hospital because I know the supporting mechanism around shopping and things like that for those type of locations. So that's always good for us. If I'm looking at, if someone sends me a deal and I go take a look at it, I'm like, where's the nearest hospitals? Where's all the shopping? Where are all the jobs? And naturally, if the rents are still affordable at that location, and I know at some point those rents are going to be anywhere from $600 to $700 more in the next 7 years. If we think that, if I believe that, if I can look at that and say, okay, that's consistent, then I'll definitely take a look.
Yeah. Tell me, when you're working with investors, tell me about your communication plan. How do you keep folks informed and updated through the life cycle of an investment?
Naturally, like anyone else, right? We do our investor calls, investor briefings. We want people to come out. I like seeing stuff. Unlike other people, like, I don't want to look. I'm like, I do. Like, if you can make your way out to what we're doing or get a good understanding of looking at an asset, I invite those people to do that. We're constantly saying, hey, look, let's jump in a car. Let's show you some general areas and general properties we're targeting right now. But aside from that, it's like our normal stuff, investor relations, phone calls, investor Q&As on a monthly basis, quarterly basis and breakdown, any type of reporting that we have. And people can come up and really go through whatever we have during any time. So that's how we actually communicate with our investors.
What does attract an investor to your asset class, to multifamily as opposed to some other asset class?
It's simple. It's simple. And you know what? I'm not a person who's all over the place. Like I said, I do my other stuff. I buy houses. That's not for the fun. But if you like, for me, when I'm like, hey, we're only doing multifamily, we're only looking at a property that's in this general area. So if it's not, and it doesn't have these little things that Victor likes to see around it, like the hospitals and the shopping centers, some money flowing into that area, I'm going to pass. And I think because I'm stationary, it allows my investors to say, okay, good. Because I talked to this guy. Now he's talking about office. He's talking about hotel conversions into multifamily. I'm like, that's awesome. And some people are able to pull that off. I have not. So, and then, I've been doing this for so long, I can take a look at my own track record and go, when have I made the most money? Even in residential, it's pretty houses, apartment buildings, nice apartment buildings. They're not heavy lifts. And I'm not a contractor. So, I have people that look at stuff and say, this is what this is going to cost over the budget or whatever. But I'm very consistent. So I think that attracts my conversation to investors. They're looking for that consistency.
When passive investors are looking at, potential opportunities, what should they be looking for in an operator?
One of the main things is some consistency. And I just had this conversation with someone the other day. It may not be for everyone, but I believe I'm like, you have to have somebody that's been around the block a little bit. They've either went full cycle on a few deals where they've bought it, refinanced it, they've cashed out everybody. That's important because a lot of people haven't done that yet. And then next, they have to have a little bit of battle scars. Like and I got it. If somebody got in 3 years ago, they don't have battle scars yet.
Yeah.
And it's not a market battle scar. Everyone's like, well, the market turned. Like, great. We're all in different markets if you've been in the business for a while. But how do you handle a situation? I heard a guy the other day say, I've never lost anyone's money. And I'm like, well, when is that going to start? And whose money are you going to lose? Because you need to know that you have a plan. It can't be in theory, right? Like, what are you going to do? So I think that's valuable. If you're talking to a fund manager, is like, somebody who either a fund manager, syndicator, I think it's going to be valuable over the next 10 years. You're going to be dealing with more people like that. They need to be able to have those conversations. Like, what was your worst deal? What is your best deal? What is your expectations? What if this thing goes sideways? What if you get slip in the bathtub and hit your head? What's going to happen? Right? Like we need to know that. And a lot of those answers should also come not just from the fund manager, but from the asset itself. If I slip and hit my head in the tub, it shouldn't be an 8-plex that you should be worried about. It should be 80 to 150 or 200 unit deal with professional management, third party, and a team that they're going to keep that asset going because we are in a capacity that things are written down, things are, already properly allocated from operations. So I think people that want to passively invest, they do need to ask those questions. They need to have good answers for them too.
All right. So somebody identifies an operator. They're like, all right, great. This is somebody I'd like to put money with. The next step is, what are they looking for inside of a deal, or in your case, inside of a fund? What should a passive investor be looking for in those instances?
Yeah. Well, and we'll address the deal. Like, first, the deal needs to be solid. It was like, does this deal look like it's going to lose capital at any point? Is it a heavy lift? Do you have the team for it or the capacity for a heavy lift? That's that. The fund manager, like we said, do they have a track record? Have they been around for a while? How's the fund structured? Is it confusing? Our fund structure is an 80-20 split. We don't have a pref. I had a pref. We were explaining it to everybody in the time and in the market where everyone was kind of, we got to get 6, we got to get 8, we got to get 12. And I was like, you know what? I think that's going to hamstring a lot of good fund managers and syndicators in the future. And look at what it's done, right? Those guys can't get out. A lot of the promises that they made a couple of years ago, they may not be able to execute on those promises. A lot of investors are going to be upset about that. It's going to be tough. So I just like, hey, look, as a fund manager, I want to keep it simple, guys. You're going to get 80-20 of all of the equity, of all the cash flow, of everything over and above our reserves. And then that way we're not jumping through hurdles and you don't have these fears and concerns about what if you can't produce. Like, the production is going to be there. Right. So I think that's valuable to do. Others may not. They're like, oh, we got to get a pref. Like, I got it. That is that person's preference as it relates to how they're going to run operations over time. And that may change, but that's hinged off of the property and that's hinged off of the structure of the operator and how they're bringing deals to the table and what they're offering their investors. And I think that's the best way to look at it.
What are you most excited about this year?
My fun, man. I want to close huge deals. I really do. Like, I have a big goal. I've always had big goals, but I allowed my limited access to properties because I was doing a lot of stuff in Hawaii, and then I was doing about stuff in other states, and then I was like, all right, I got to focus in Hawaii, and it was limited product. So now I moved here with the premise that I'm going to do something big, because I'm really just doing what I've always done. But now I'm in something big enough where I can do something big, and I can actually bring a lot more people with me to do that, because I've wanted that. I've wanted someone to help me. A lot of people have, and now I can turn around and I can help other people with their investments. So that's exciting for me.
One of the things that's totally unique, but somewhat unique to me, it seems like you've got a comfort level in operating in wherever you happen to be physically. You like to be able to go see it, understand the neighborhoods, understand the nuances of the opportunities that exist. Is that fair to say?
It is. So years ago, I didn't know. I was telling someone the other day also too, like I didn't know it was the market crash. I just thought Victor was getting spanked. Right. So, so I bought a property from Hawaii in Ohio, and that property tanked. We had a property management issue, who was also our project managers. I was flying down there, sending money. All our escrow accounts got drained. We ended up having to file for bankruptcy over that deal back then. So again, just felt like me, but later I look back and like, oh wow, the market crashed. It was everybody going through the rigmarole, because it felt personal. So that was my lesson. So I had to rebuild after going through bankruptcy for 12 months, having my case kicked out because we didn't turn in some paperwork in time. The judge was like, refile in 180 days. I'm like, sir, we didn't do anything wrong. Right. I actually, from there, I picked up $11 million worth of real estate in Hawaii in my own backyard. Prior to that, I was doing deals there. But I was probably like everyone else, like, oh, you can't really make a lot of money in these low cap rate markets. It's too high. There's no returns. But there was tons of people making money there. I just hadn't got introduced to any of them. Yeah. So after that experience, my buddy that owned a bunch of apartment buildings, he was also a broker, was like, look, you're doing it wrong if you're going to do it in markets like this. Here's how you do it. And here's what you need to do. And oh, by the way, here's a potential deal to cut your teeth on, but you got to go raise the money. So I was back in doing what I knew how to do. Yeah. So once I learned that, to your point, I stopped looking in other markets. I moved here because rather than live in Hawaii and buy in California, I was like, let's just sell everything we got, pack up, move the family here, and let's hit the ground, because now I'm not guessing about what's really happening in this market. Unlike other people, they have to fly, they leave. You don't know. I've had that experience. I'm not interested in that. And I don't, now I'm not really interested in losing someone else's money. If you were to give me $1 million, you'd kind of want me to see it.
Sure. That's fair to say. I'd kind of want you to do more than just see it, right?
Yeah. You want me to know. You want to know. Vic knows what he's talking about. He's there today, right? Yeah. So I think that's valuable. It is, and I'm not beyond those activities.
That's good. It's good to get an understanding of that, and I love the ability to be able to see it, understand it, and know that market inside and out. Mm-hmm. Let's just move on. I want to move on to the final segment, what I call the final four. What do you think holds most passive investors back from hitting their personal next level, whatever that is?
Fear of not being in control. Fear of not being in control. Like I think a lot of people who really want to be passive, they've watched other people who are actually active and it looks sexy. So I think the concern is being passive in a deal and not being able to control what happens. So the assumption is that if I invest, I'm not an investor, but that's not true. If you invest, you're actually an investor, and that's kind of just a title. So I think that holds a lot of people back, fear of not being in control of the asset because they're concerned.
What's interesting is, and I echo exactly what you just said. Somehow when somebody invests in an opportunity, in a property, in a syndication, they have that fear, but somehow when they invest in the stock market, that same fear doesn't exist for them.
Not at all.
When you also, you have no control over the execution of the business. And then separate from that is what happens in a market, which none of us control, right?
Right. You wake up and your money's down and you're like, oh, wow. And all you can do is like sell and trade and, stuff like that. But with real estate, and that's why we mentioned earlier, the better quality asset does matter. So then the real estate actually controls the capital, right? Which makes your selection process a lot better because now you're like, all right, cool. We can't control what's really happening. None of us are going to give $1 million and walk away with that property tucked under our armpit out of the door. Like it's still there. So if that's where if you're moving your money from into real estate and you look and you go, okay, now we just need to control the real estate. We need to control what happens operationally. And if it's a functional deal, because we're really buying a business, to your point of the stocks, we can manipulate the business operations activities. We can move people around and raise. But we can't do that if we're looking from the outside and saying, okay, I got to control this whole thing. So I'm afraid to invest and be passive. Like, it's different.
Yeah.
Yeah.
What's your biggest passion outside of real estate?
That's a great question. Right now I really don't have an answer for that. Like, it's growth, like personally,
Yeah.
I've done a lot of stuff, like athletic wise, but I spend a lot of time with my wife and my kids. I love them. I love working out.
Yeah.
I'm competitive, I like MMA and jujitsu and things like that. But that's kind of my passion. I don't have a lot of passions outside of my goal. I'm really excited about that, where we're headed.
Your favorite book?
Other questions. I listened to an Audible book. It was called How to Invest. And I can't remember the name of the guy, but it's one of the guys he does a lot of interviews. And I think he's from the Carlyle Group. He's one of the guys that are in the Carlyle Group. That's a great book. And I stopped reading books and I really started studying people who have big companies like, Larry Fink, Steve Schwarzman, Sam Zell, things like that, because of the industry I'm in now, because I wanted to know what they did. But that's a great book. If I'm wrong about the title, it's because it's an Audible book. But that's really great. That's one I've been listening to. I think it's awesome.
What's your favorite way to make an impact in the community?
Talking. Like, I love speaking to people. I'm a permission guy. I love people who want to succeed and do big things in their life, because I've always wanted that. And realistically, I've really just wanted permission. Not, like, it's like, what do you guys think? Like, even though I believe in it, sometimes it feels good to have a friend go, dude, you should do that. I think you should. So I love talking to people and speaking to groups and things like that for people who want to grow and go bigger in their worlds. Yeah. And just be like, dude, you guys should do that. You owe it to yourself and you owe it to the people you care about to actually give yourself permission to go do those things. Because the times that I've been miserable are the times that I deny myself the things that I actually know I'm capable of, and I don't do it.
For people who they want to find you, they want to connect with you, they want to follow you, they want to learn more about your fund, what should they do? Where should they go?
Yeah, sure. Hey, thanks for that. They can go to bell-capital.com, or they can find me on Instagram, The Real Victor Bell, Facebook, Victor Bell, YouTube at Bell Capital, because YouTube has that at thing now. Yeah. They can go there, or they can just Google Victor Bell or Bell Capital, and I should pop up. And any questions anybody has, I love talking to people. It's a passion of mine also. Yeah. So if anyone has questions or concerns, they're trying to do this themselves, I can help, or they want to invest with us, that's great. We can answer any questions, but I'm here.
Perfect. We'll make sure all those links you just referenced will be below in the show notes for anybody. Victor, I appreciate you taking the time to connect. You've got an amazing story about what you've gone through in your life. And then, it's fun to hear somebody actually being in Hawaii, going through things and making a go, as you referenced, in a low cap rate environment. And some people would categorize, probably a lot of people would categorize California the same way. But you've been there, done that in Hawaii, and now you got something big in the hopper, if you will, in California. It's a fun story. And I'm glad we got connected here today.
Hey, and thanks so much for having me. I really appreciate it. And thanks for what you're doing for people and the listeners and stuff. And I like to share that because, had I had the information like this when I first started, I'd probably be 10, 20 years ahead of where I am today for that. So thanks for what you're doing for people. I really appreciate that.
You bet, man. Thanks for your time. To our listeners, pat yourself on the back. You guys have made it to the end of the show, and most people never finish what they start. If you receive value from today's show, be sure to share it on LinkedIn, your Facebook page, or your social media platform of choice. Subscribe to never miss a valuable episode in the future. And if you found value in today's episode, give us a thumbs up with a positive review. If there's a particular topic you'd like to hear about, well, I want to hear from you. Shoot me a message on LinkedIn. The link to my profile is below in the show notes. You can connect with me there for more valuable content.